Welcome back. I'm very pleased to announce the next session, which is hosted by Fidelity International, and it's how to implement an investment portfolio decarbonisation pathway. We have three individuals from Fidelity speaking to us today. Anna Victoria Quaas, who's Investment Director within Fidelity's Global Fixed Income team, focused on climate-financed income strategies. She's joined by Glenn Anderson, who is focusing on sustainability innovation and integration into investment processes, development of thematic capabilities, identifying sustainable investment trends and strategic opportunities. And certainly last but not least, we have our moderator, Solène Garnevalt, who is Senior Manager, Client Support and Marketing based here in Luxembourg. The floor is yours. Thank you very much.
Thank you, Denise, and good morning, everyone. Thank you to LuxFlag as well for giving us the opportunity to talk about decarbonisation today. So just to put it a little bit more into context, so Fidelity's international role is definitely to lead and safeguard, enhance the funds that we manage. So in terms of climate change, this means that we need to understand the key risks and the impact that could have this risk into our own portfolio. And we have to make sure that we help also the issuers mitigating that risk. And we also have to make sure that we are investing into climate solutions. So in the past 5 years, the emissions covered into decarbonisation pledges have risen to 70% of global emissions. And this needs to be further developed. Individual investors have definitely to play their part. And that's also how we have to help them to making sure that they are definitely working in that direction. So in today's presentation, Anna and Glenn will show you how to implement, consider the general options, advantages, but also challenges to implement a decarbonisation strategy. So Glenn, the floor is yours.
Thank you very much for the kind introduction. It's a pleasure and an honor to speak at LuxFlag's Sustainable Investment Week. Portfolio decarbonization, I think many of us have heard the terms of 1.5 degrees, net zero, etc. Day to day, we are working through the challenges of really how to implement that in the portfolio management activities to serve our clients' needs and to really address the climate risks and capture the climate opportunities. I thought to start from a bit of a pessimistic slide. This is what has happened this year already in India. It's land surface temperature, and that white spot in the middle, that's not snow, that's temperature of 62 degrees that has hit. I'm sure we can all enjoy this rather moderately warm temperature in the room today. I'd want to encourage everyone to think about how would we feel here if we were sitting at 62 degrees in our suits or formal attires. I think that would be a bit of a different environment. What that means concretely, more concretely though, is the translation that climate change has on conflict, on disruptions across the world. This is a graph whose purpose is to show how much change and how quickly change can happen over the span of a decade. Between 2000s and 2010s, the number of water-related conflicts has roughly tripled in most of the regions. So these are conflicts that may be causing military disruption, by civil disruption, business disruption. Trust me, it gets more optimistic from here on out. So we're seeing the solutions to decarbonization broadly in three main steps across portfolios. The first one being to set net zero target, to use active voting decisions that we can as Fidelity International, and to really engage for concrete emissions reduction. And I'll keep coming back to that last point because to us, the reduction of emissions and climate change is not just a factor of tilting out of the portfolio, selling the high emitters, buying the low emitters. It really is to play a critical role in reducing the emissions on the ground and support the companies and the heavy emitters throughout the process of this. So the toolkit that we are leveraging across this is on 4 buckets. Unfortunately, I don't have a single silver bullet to say this is going to fix all of the climate change problems. So instead, for us, it really is a toolbox that we're using here, as we see that each one of these tools is best fit for various types of challenges. For example, the emissions profile allows us to see concretely which issuers may be tackling the key metric that matters the most, which is the emissions. Who may be on the right paths, who may be aligning themselves to where they need to be in 5, 10, 30 years' time. Climate rating is a proprietary tool of ours that I'll come back to, which forms our qualitative view. How are they achieving it? How sure are we that they are going to achieve that net zero alignment? The revenue portion is another side of the coin for us that allows us to look at not just how a company is operating or an issuer is operating, not just that, what are the emissions that they have emitted, but really what is it that they do as part of their daily activities, daily business, and where there may be some of the opportunities really to capture on climate change. And finally, again, it's the engagement portion that ties it all together to make sure that we are there to support our investees and that we do use our role as a lender and as an owner of investees to support that transition to climate change. To walk the talk, we have set also our own targets, both at a corporate level, so that's our travels, that's our office footprint, but also at the investment portfolio level. The investment portfolio, we're reducing, we're targeting net zero by 2050 and half the emissions by 2030. On the corporate side, we're looking to be net zero by 2030. This is important one to start off the discussions with many of our investees actually, because it already sets the tone of the conversation so much more, where we can say that it isn't just something that we want to ask you, it is something that we believe so much that we have decided to do ourselves. On the climate rating is one of the ways how we're starting to bring that discussion with the investees really to life. And it is broadly by asking 3 topics. One is, what is the net zero ambition that you have set? So similarly to how we have set our own corporate and investment targets, we are also asking the firms and the investees, do you have a net zero target? When is it supposed to be? How are you going to reach that? To ensure ourselves that this isn't just something that they will sell off their assets at 2049 and that's it. It's also looking at climate governance and capital allocation. So the governance aspect is to make sure that whatever they're telling us and the rest of the world is that we have to believe that there's this required support, and as we heard previously, the tone from the top to really drive and facilitate that change, and capital allocation to see if they're really putting the money behind that. Furthermore, on the revenue alignment, I briefly touched that there's a big part of the solutions that need to come for us to tackle climate change. The graph on the left here, the red line is, to put it simply, the business as usual scenario. So this is the emissions trajectory if nothing changes. And the red line is likely to bring us to at least 4.5-degree temperature. And in that scenario, we will be swimming to the next investment week summits if it comes to that. So really where we need to be is the light blue line here and the green lines. In order for that, there's a lot of work that needs to be done on implementation of technologies. The 65% of that reduction between the red and the blue line can actually be achieved by technologies that are present today and that are economically scalable. So a lot of the problem is in finding that 35% of technologies, those that either may not exist yet, or they may but need more economic competitiveness to be in there. So by focusing on the 65 and the implementation of those as rapidly as possible, those are the revenue activities that we really need to be able to find and support for the emissions to be going down. As part of that, what we have done, one of the technologies that does not fit in a net zero world according to the IEA is thermal coal. And we have set for ourselves the target to phase out thermal coal across our portfolios in the OECD countries by 2030 and the non-OECD by 2040, in line with IEA's net zero ambitions. On voting, as we are a large and influential equity shareholder in many of the firms that we invest in, there are three things that we want to see in them. We want the right ambition. We want to encourage the right ambition when we have a chance to vote on climate matters. We want to see clear disclosures for us to be able to assess this information. And we want to share as well as part of the journey to the companies when we vote against them, why we vote against them, so that hopefully the next year when the votes come back, we can have that continued discussion and see how some of the reservations may have been addressed and resolved to really see that change happen underlying it. So what we have done is set out a commitment to vote against directors in high-emitting companies if they do not meet our minimum criteria on climate change. And there we have split out the high-impact sectors, really those that without whom reaching 1.5 degrees will not be possible, and also a general expectation towards all sectors. The assessment criteria are here, and they are very consistent with how we assess and analyze companies with the climate rating. It really is about policies and disclosure. We want to see it. We want to see the data. We want to see the information. As we do believe that what gets measured does get managed. We want to see the right governance frameworks. We want to see board-level oversight in support of it. We want to see reduction targets in these companies. And we want to see two critical factors, which probably the most difficult to quantify, and that's where we need a lot of qualitative work to be done. And that's credible strategic direction on net zero and scenario planning. So that the companies themselves start talking about what happens if carbon price goes to 200, what happens if a key supply chain center gets impacted by climate risks, etc. To date, we have identified more than 800 target companies on this. We have communicated the voting policy to them last year, and we have been working, of course, through this year and onwards on really driving this forward. And we see that we're not alone. The graph on the left shows the percentage of support on Say on Climate proposals. The Say on Climate proposals, to keep it simple, are an item during the annual general meetings when companies showcase their own climate plans and climate disclosures for investor feedback. And investors will then vote either they support them or not. We saw that originally there was quite a high level of support across some of the large names. This year that trend has drifted lower. Some of the potential reasons for that has started to become much more granular. So for example, Scope 3 emissions reduction targets, the timing of coal phase-outs, and really starting to unpick the individual elements of these votes. Finally, engagement and how we want to support the companies through the journey. Again, this isn't a case where we just want to sell out of the high emitters and invest into the low emitters. We want to be able to transition these high emitters lower. Our background is really rooted in fundamental research. We do have a team of more than 160 analysts globally, and that gives a very deep breadth of established connections and communication with these firms, a relationship of trust as well, but also on our side a very profound understanding of the sectoral expertise and the constraints within which many of these issuers will be operating in. As an example, I wanted to talk about an engagement that we did with Chinese oil and gas companies. China is a necessary component of the world reaching net zero. In its corporate environment, many of the firms are also state-owned enterprises, yet we do have the chance to engage with them, and in collaboration with other investors through Climate Action 100+, we were able to have the structured dialogue with them. Subsequently to that, we saw that disclosures that improved by these firms. There was much more communication about strategy on hydrogen, and in this case, what was a positive for us, this is where it gets into the color wheels of hydrogen, that they were starting to talk about green hydrogen production, not just the brown and the gray, so hydrogen that does have much lower carbon footprint, and that they also committed themselves to a net zero target, which was a massive first step that we recognized. So to really tie it all together, the way how we see portfolio decarbonization come together is that it is a modular approach. So coming back to the 4 building blocks that we see around climate change, is that what's necessary is the consistency within them and a high degree of standard to which we hold our own investment practice. But there are different flavors to it, and that really reflects the spectrum of preferences and the ways how climate change can be tackled. There's room for solutions and really supporting firms that are either at the forefront of that 65% implementation or working hard on finding the 35% of technologies that need to be developed for net zero. It's looking at transition to invest and to support the issuers that are leading the pack on their own actions, where we see room that we can engage and help them leapfrog into that net zero, or also cases where it's a best-in-class approach, where our clients may want already a portfolio that is as close to a net zero portfolio as possible, that will be reducing their emissions year on year. But at the end of the day, it's the consistency of the building blocks for us that matters. Thank you very much, and I'll be handing over to Anna.
Thank you, everyone, and it's a pleasure to be here. So thank you very much for taking the time to listen to us today. So I will be talking about how that which Glenn did such a great job of sort of lining up, how we're going to be integrating or how we look at this in the context of a fixed income portfolio. And so why specifically kind of focus on fixed income? I still think despite the sort of rise in sort of interest in this area, still relative to, say, the equity space, it's something which is still very much under development. In a similar fashion to Glenn, I'm afraid my first slide isn't also very positive. So if we look at what is actually required to get us to a net zero economy, you can see, and sorry, it's a very text-heavy slide, but if you focus sort of on the numbers in terms of the investment, either in terms of total decarbonization or specifically around energy transition and buildings, you'll see that these are quite some sort of staggering numbers. And that's only really focusing sort of on climate, on the sort of decarbonization story. If we add into that, which is sort of a belief that we have that climate and biodiversity, so nature loss is deeply interconnected, we add another couple of billion. So where do the global debt markets come in? So it'll leave you with a little sort of, or to give you a little fact, So 25% of global emissions are generated by 25 of the largest companies, but only 25% of them are actually listed on the public equity markets. That means 75% are not, you cannot really engage with them as equity holders, and this is where the global debt markets come in. If we look at the size of the global debt markets in that context as well, the global debt markets are around 25% larger than the equity markets. So thinking about the sort of importance, the role that bondholders play, we can see that we actually have the opportunity across a much wider spectrum, whether private companies, governments, quasi-sovereign, securitized issuers, to be able to kind of engage on this issue. And if we look at the financing that comes to market every year, if you look at in 2021, in 2021, around 12 trillion sort of came to market and was raised by companies. 5 trillion came via bond issuance, and only 1.4 trillion came via equities. Why is this important? Because every time a company comes to market, it's an opportunity to engage on this issue. So how should one really sort of think about it? And I think Glenn talked about, the companies that are sort of transitioning and the investments and the potential for this sort of 65%, if 65% can be sort of adopted, we can already get sort of far away. And so the way that we sort of think about it is in terms of a couple of different buckets. Is companies that are already evidencing leadership within this sort of space. And you can think of, and I'll show you an example sort of specifically, companies that are transitioning. And then looking at sort of specific kind of project financing, so through green bonds. So the way that we think about it in terms of sort of in the fixed income space around how to decarbonize a portfolio is really to, as I said, sort of divide it into two buckets. And these can be issuances, standard corporate issuances, or green bonds specifically, focusing on companies that are adopting decarbonization practices or tools faster than their peers. And this can be across sectors, because the belief is very much that every single sector needs to decarbonize. And then focusing where we really put the majority of our efforts is sort of on the climate transition. And these are a couple of key economic sectors that we believe that need to decarbonize, where we also know that it's very difficult, and where we look sort of specifically, as sort of Glenn also mentioned through the sort of climate rating, to look at what are the ambitions of the companies, what are the decarbonization targets, and what are they adopting in terms of sort of practices. And you can see at the bottom sort of two examples. Microsoft should be hopefully a sort of well-known company for you. I mean, they're net zero already, but they're actually raising the bar in terms of their own ambitions to really make up for all the emissions that they've generated over a lifetime. Traditionally, if we were to think about it, technology is deemed to kind of be a lower carbon sector. If you look at specific kind of low carbon strategies, you'll often find quite a sort of heavy tech weight. The other example is Fortescue Metals Group, and that might be one that you're less familiar with, but it is the 4th largest iron ore producer. And this is a company where in itself is very high in terms of emissions, not only in terms of scope 1 and scope 2, but more especially in terms of scope 3, and we'll look at that a little bit later. Why is this company leading? Because they've actually set across all 3 scopes, and scope 3 being the quite difficult one, really ambitious targets by 2030 for scope 1 and 2, and 2040 for scope 3. And they're doing this through investments in new technology. So to focus on kind of the areas, if we come back to looking at sort of lower carbon strategies, if you take a portfolio and you have low emissions, what you'd often find is that there would be quite a bit of underweight in that kind of space, because your ambition is to have lower than benchmark emissions, make it seem very optically clean from an emissions profile. But in terms of real world impact, where we need to not be swimming to the next Sustainable Investment Week, as Glenn said, is we actually need to decarbonize these kind of key economic sectors. And so built environment, real estate, industrial transportation, the food supply chain, and energy. If we're able to decarbonize these, and I would encourage you to read the UN emissions gap report, we will be on a very good trajectory to reaching 1.5 degrees. But of course, these are the most difficult ones to decarbonize. But it goes beyond that, actually. There's an argument for focusing beyond emissions reduction. Actually, especially if we sort of focus on mining and industrials, a lot of these companies play a critical role in terms of the transition to renewable energy. So what you can see here specifically, if you look at sort of the sort of chart on, what will it be? Your left-hand side, you will actually see the metals and minerals that are required to, for example, support renewable power generation, electric vehicles, and carbon storage. And we can go a step beyond that. Steel is one of the highest emitting industries. It is often one for emissions reductions purposes in portfolios that is often taken out of portfolios. But actually it has a very sort of positive role, as you can see here, in terms of offshore and onshore wind generation to be helping us transition to a lower carbon economy. I will just briefly sort of touch upon this. So we looked at I mentioned the example around Fortescue. So when we're looking to kind of get a little bit more granular in terms of how we're looking at companies, what's really important on a very, for specific sectors, often investors will only focus on scope 1 and scope 2 emissions. But as you can see here, if you look at the fourth column, scope 3 of total, particularly in high emission sectors, what you'll see is that for many of them, take ArcelorMittal for particular reasons out of the equation, but for a lot of these companies, for the majority of these companies, scope 3 emissions is actually the largest part of their emissions. But that is also, if you look at the emissions targets, where often there is the least focus. So why do we take Fortescue as an example? Because they've set those net zero scope 3 emissions by 2040. There's the question around performance and actually decarbonization. So does decarbonization come at a cost, in particular for these kind of high emission sectors? So using again the sort of example of Fortescue, it's not only about the cost and the cost of decarbonization, but it actually presents opportunities, as I think it was touched upon in the previous panel discussion, presents opportunities actually for companies. So this is currently a high yield stock or high yield issuer, and what we're actually seeing is sort of through the investments that they're making and through the way that they're looking to adapt their business model, also the engagement with their customers and their suppliers, that there's the potential for them to be deemed a less riskier asset. So it's an investment not only in terms of their own emissions profile, but also thinking about their long-term sort of business model and how they will remain competitive. I'll skip over this one maybe, but this is just to emphasize is sort of decarbonization. You need to also take into consideration other aspects such as biodiversity as well. Glenn touched upon engagement. We think, for us, especially in these kind of, these high emitting sectors, it's really, really critical. And this is an example, this paper and pulp producer called Suzano, and they have been, it's the question always also, how do you engage as bondholders? They're very sort of high emissions, in a very high emission sector, tied with also biodiversity issues around deforestation. And actually we were able to engage with them they came to market with a new issuance, and we sought to engage with them looking at, they already have ambitious net zero targets, but what we actually noticed was the fact that they didn't have any biodiversity or deforestation targets. So over a sort of time period, and the engagement is very much still ongoing, we've kind of set to actually raise the bar with them in terms of saying, if you come to market again, our expectations as bondholders need to include that you are also taking these things into consideration. Just very quickly, how we sort of think about it. I mean, it is I think, as sort of Glenn alluded to, it is not only looking at carbon emissions specifically, but it is looking at the whole carbon profile of a company, as well as the sort of transition pathway that they sort of have under place. How are we for time? Fine? All right. I think these are my last 3 slides. I just want to sort of show you in terms of, so in terms of the way that we sort of approach this, we don't actively, with the exception of the firm-wide and what Glenn sort of mentioned around sort of specific kind of exclusions that we'll have in place, say around thermal coal, we don't purposely exclude high-emitting sectors. And yet you can still achieve within that to have a lower sort of than emissions, lower than benchmark sort of emissions target. But the question is, how do you do that? Now, in most cases, and I've spent probably way more time than I'd like to, looking at different strategies and looking at their different sort of climate approaches. And what becomes a common factor is people want to, for your own comfort level and also disclosing to your board and your different stakeholders, you want to be able to show how you have lower emissions than sort of the overall benchmark. But what that often comes at a cost in terms of the sectors that you're investing. And that in turn comes at a cost in terms of your diversification and your performance returns. But I want to show you that it's actually possible. Because if you look at the sector allocation effect, and I'll specifically touch upon energy, because I'm sure everybody will see that there is an underweight in energy. But all in all, if you look at the sort of sector allocations, it is in line, give or take, with the sort of benchmark. So there's no gaming in terms of trying to garner kind of points from a sort of sector allocation point of view. Where you actually see it in materials and utilities are the two, you saw those on the decarbonisation areas. Where you actually achieve that is by looking specifically at these companies in the very sort of granular way that Glenn sort of described, to identify those that are really sort of leading in terms of practices. Energy is very specific because that actually falls into a high emission sector. To date, in terms of sort of net zero plans, it is still a very, very challenging one. In terms of SBTI targets, there are, or science-based initiative targets, there are none within that space to sort of be seen. So looking at to the point of sort of making sure that what you're taking in is really contributing to transition, that is a space that still needs to evolve. But it is not one that we would purposely sort of exclude, because we do believe, and we do have some examples in there, that there are companies that are on that sort of pathway. Now, and that is I believe my final slide is, so you don't exclude anything, and how do you still get to net zero? Well, it is still in this particular case possible, where it is that focus on that multi kind of faceted focus on emissions profile today, technologies, but also looking at the targets. So we have about 150 issuers in this particular example of this portfolio. And what you can see is through everything kind of combined, you can sleep well today, and you're aligned to 1.5 sort of going forward. So I guess the sort of message around it is, if you look at it in a kind of holistic way, and you're looking specifically at the companies and at their profiles, you shouldn't have to find yourself in a position where you're taking huge sector over underweights just to basically reach your climate targets. And with that, that's me.
Thank you, Anna. Thank you, Glenn. Is there any specific question from the audience? I, of course, do have a few, but I would be happy to prioritize yours, of course, if you have any.
I have a question. It was very interesting to hear about the engagement piece and how important it is. And maybe it's just because I've been so focused on sustainable finance, but it seems like engagement is even more important than it ever was. But I guess given what's at stake. But it would just be interesting to hear a bit of, obviously there would be some companies, perhaps some specific issues that you as Fidelity International would want to engage directly with the company with, but is it becoming more important actually to join together with the initiatives such as the Climate Action 100+ on topics like this so that you're all speaking with the same voice and all pushing? I guess that's the value of that. You're all pushing in the same direction.
Absolutely. I think the collaborative engagements have a critical role to play in the success of engagement activities as a whole. From our perspective, I think what has also amplified those engagements, particularly in the thermal coal sector, are the very clear targets that we have set for ourselves, which start to shift the tone in some of those conversations, that this is an issue that we're not just conversing because it's an issue that we need to talk about. It's an issue that we're conversing because we know what will the results be for both parties if, for example, thermal coal transition plans do not get put in place in the right amount of time and with the right level of ambition. Some of the problems, though, that we are seeing are some of the limitations around the speed and the time of the climate change transition are those that do require sector-wide or almost economy-wide solutions, particularly in those high-impact sectors. The reasons, for example, for steel and cement sectors being very carbon-intensive in their process is, for example, with steel, is that you need to achieve very high temperatures during the smelting of the iron ore. And for that you would usually use coal for the heating of it. So that's a concrete example where we need to engage with the industry as a whole for them to and to encourage them to also then work on solutions that they can find both practical, applicable, and economical. And that's a clear example of an issue that goes beyond the size of just one company or one firm. Yeah. Anything?
Yeah, I think even sort of, collaborative engagements between the different asset managers, but I'd even say sort of internally. I mean, the way that we sort of think about it in terms of engagement is we have sort of, I would say, 4 kind of different levels at which we sort of engage. One, which can be, say, for example, with a specific sort of issuer. The second one being actually where we kind of have common holdings across equity and sort of fixed income to really kind of pool those resources. And then I think, also working with sort of Glenn's team in terms of their specific kind of sector-wide issues where we kind of identified and where we need to kind of, we're looking at, maybe sort of 10, 15 companies where we know that this is a particular issue. And then you go to the collaborative engagement. So I think, yeah, joining those, not doing it alone, but doing it kind of collectively, irrespective of what kind of area that is, is it really sort of, is a kind of key thing to making it into success.
And if I may add just to that point as well, one that I believe doesn't get talked often as much are also really some of the cultural and the personal sides of engagement. At the end of the day, around the table when we are engaging with issuers, those are still people on the other side. And there's been some fantastic research that was done by the University of Cambridge before that also showed, and we're seeing this in practice, that oftentimes the dynamics in a collaborative engagement can work better than just individual engagements. If you can have lead engagers that have those existing relationships or have that cultural connection to the firm that they are engaging with, often that message may actually resonate and come across off much more naturally and much more understandably in there. That goes even further if these local investors that are engaging are supported by international asset managers, as that also then starts to highlight the weight and the importance of these problems. So these are also, I think, the dynamics of where we're trying to play a part in collaborative engagements, really.
Thank you very much.
Thank you. So I think we can close the session. So yeah, thank you both for the great insights, and thank you for having us today.
Great. Thank you so much, Anna. Thank you. Thank you, Glenn, Anna, and Solène. So appreciate it, and thanks for Fidelity for hosting this session. Really interesting, and good luck. So our next session is with LIST, the Luxembourg Institute of Science and Technology, and that will begin at 5 p.m. Thank you.